Dhiraj Sachdev, Senior Fund Manager Equities with HSBC AMC. Dhiraj, good morning. Thank you for joining us. Everyone wants to know that are we looking stretched or at 6,500? Our market still fairly priced?
Yeah, good morning, Nikunj, to all, and all the viewers. We are fairly positive and constructive on the market despite the recent run of late. Let us examine a couple of issues. The macro things are showing early signs of reversal on the positive territory. So be it current account deficit or CPI inflation, which was released last evening, or even some element of improvement on the currency front, indicates that the imported inflation will be far less going forward. Second is the earnings season, which got concluded in the month of December, in the quarter of December, shows the second consecutive earnings upgrade cycle beginning to happen. So while it has been largely led by technology sector, you're already sensing even the pharmaceutical or health or the agrochemicals or textiles participating and giving an indication of positive surprise. So other sectors have reasonably participated in better earnings, positive surprise in the December earnings season. Third is, despite the election environment, you are actually seeing some kind of positive push on the reform side. So be it the continuing ongoing monthly increase in the diesel prices, which means that eventually the diesel subsidy will be brought down from over almost 900 billion rupees last year to close to 200 to 400 billion rupees in the next financial year. So that's a welcome change. You're already sensing power tariff increase by many states in the last 2 years, and also the financial restructuring of state electricity boards. The cabinet has already given approval for linking natural gas to market link prices. So despite this environment on election side, you're seeing positive momentum on the reforms push. So our sense is that yes, the other sectors which have been into hibernation for the last 2 years, be it industrial, infrastructure, capital goods, banking, etc., and the market was so polarized on the IT and pharma side, is beginning to see some kind of a positive traction.
You've given me 5 factors where market should go up. Let me give you one factor which will trump all the argument, which is tapering.
Well, tapering is largely discounted, Nikunj. It has been the noise has been made for the last almost a year and so. So we do not expect a meaningful correction if tapering happens. Generally, the global markets crack on negative surprises, and tapering has been much talked about, more gradual in character, and markets have eventually discounted that part. So our sense is that it's not going to be may have a meaningful correction on the Indian side, because the Indian market may sense positive outcome of elections if it is so, and also some kind of an earnings upgrade cycle for the other sectors to participate.
Dhiraj, it was interesting that you were, saying earlier that it would be wise to now move out of IT and pharma. Are you that confident of the market scaling new highs? Because most experts that we've been talking to, they're saying stay put with IT and pharma, but do diversify to cyclicals.
No, I did not mean that you have to move out of IT and pharma. See, IT and pharma are more structural stories in the sense that both the businesses are very capital efficient. Most of the companies in the sector are zero debt in the balance sheet, and they are participating in the global, global markets, and where the size of opportunity is fairly large in character. So you have a compounding element in the IT and pharma sectors. What I meant is the degree of overweight in the portfolios needs to be reduced, and one has to start looking at other sectors which have been underperforming in the last 2 to 3 years, either because of the regulatory issues or coal linkage issues or power tariff issues. And if we believe that a formation of a stable government will further thrust or improvise on the reforms front, then whether it is the oil energy sector or industrial or infrastructure sectors will start participating. Though earnings in the near term are not supportive for these sectors, but eventually it will follow. So I think the markets are beginning to recognize these other sectors and not necessarily only pharma and IT. But pharma and IT needs to be in a meaningful position in the portfolios because of their structural benefits and businesses being more capital efficient in character.
Somehow Infosys commentary is not that inspiring. So if a large cap company is struggling, this could be beginning of a trend.
Well, Nikunj, it could be a case of being very company specific, and we should not generalize to the other companies in the sector per se. But eventually we believe that the IT budgets will be on the rise. There will be new and emerging technologies which will mean more outsourcing for Indian companies. So to that extent, we remain positive on the IT sector.
Dhiraj, we've discussed IT with you, so let's not revisit IT. Let's talk about what you own. And you have a very large exposure to agri, a trade which I'm sure has worked very well for you. But is there still some more steam left in the top agri names you own?
Yeah, you're rightly pointed out, Nikunj. We do own fairly decent exposure to the agrochemicals business. If you look at the business per se, it has the characteristic of just like a pharmaceutical business where the business is less capital intensive in nature and it is scalable. You still have huge acreage of farm cultivation which is underpenetrated in terms of usage of agrochemicals. So be it herbicide for yield improvements or insecticides, etc. So we like the business model with high ROEs and scalability. And the valuations are probably at a discount to the likes of pharmaceutical businesses. So we do believe that they can scale up further despite the recent run-up, and earnings momentum should continue.
So are you happy to own UPL, Kaveri, I mean the agri stocks which are up more than what?
Yes, so the business models of each of these companies may be very different. So seed companies may extremely do well if they are able to scale up. There are insecticide companies, there are other segments of agrochemicals. So the business model of each of these companies may be very different. Some of them are export oriented in nature, the likes of UPL that you mentioned.
Dhiraj, you're betting on some turnaround in the economy and you're seeing green shoots already. Would that make you bullish on banks, and would you start nibbling in at all?
Sure, you're right. In fact, if the economy has to move and turn around, and if you're believing that the reforms push will happen, banks have to participate. Now, in the banks, the opinion is fairly divided. There are private sector banks who have held up and managed their asset quality pretty well. And on the other hand, the public sector banks have been vulnerable to poor asset quality and higher element of restructured books. But the point is that they are available at maybe 8 to 10% dividend yields and at 0.3 to 0.4 times adjusted book values. And the market is aware of it. So while public sector banks may participate in the rally tactically, unless they show a meaningful reduction in the poor asset quality trends, the rallies will be short-lived. So yes, banking in general will participate, both private and public sector, but one has to be very watchful on the PSU bank space. Every quarter when they come out with the earnings, we have to see a meaningful trend reversals in the asset quality performance.
Within the private banking space also, there are two types of franchises. Retail dominated franchise, names like Kotak Mahindra Bank and HDFC Bank, and you got corporate franchise, Axis Bank and ICICI Bank. So within the private banking space, which way are you leaning, retail or corporate?
So if the economy has to turn around, then further decomposing their lending book, I think the corporate banks will perform better than the retail banks would.
So I take your hint there. No HDFC Bank, ICICI Bank.
Dhiraj, while Infi is playing out on expected lines, would you deploy dips in IT to be a buyer?
Actually, certainly, because structurally we believe, rupee may appreciate in the interim, but eventually, given the differential in the core inflation between Indian economy and the US economy, eventually you might expect the dollar to gain strength over a longer period of time. So any dip and corrections just because of the currency front may invite a buying opportunity. But as I said, it has been quite a polarized market in the last 2 years where only IT and pharma has done well, and people have, or investors have largely ignored the reforms getting sustained despite the election environment. So you might see other sectors also participating. So the degree of overweight on the IT pharma needs to be reduced in favor of other sectors where the valuation gap between these two are very high. So you might see oil energy, PSUs, infrastructure, industrials also starting to participate. The earnings will eventually follow, and near-term earnings are not supportive in these sectors.
But some would argue that a lot of these capital goods stocks are already looking expensive. L&T has moved from levels of 850 to 1200. From a P multiple of 12, it has moved to a P multiple of 18. Ditto for Crompton, Greaves, Thermax. So maybe the easy money has been made. That trade is already over.
Your observation is absolutely right. In fact, we have also discussed about the same. So the near-term earnings is not supportive enough to justify these kind of valuations, and these are hope rallies which may get corrected in between. But if you're taking a view beyond 6 quarters, a 2 to 3 year view, yes, these companies may still look good because the earnings will eventually follow. And some of these companies have even traded at 22, 25 times. For global investors, these large companies make sense because these are larger bets and they have better balance sheets in the entire infrastructure place. So yes, they may have disruptions and corrections in the interim because near-term earnings is not supportive, but eventually the earnings will follow.
So if you get fresh allocation today, how would you allocate? Would you buy IT, which has corrected 8-10% from the recent high, or would you continue to buy into cyclicals and some of these banks which are up 25 to 30% from the recent lows?
We would incrementally deploy more money on the cyclical side. Despite some of the banks have moved up from the lows, they are still far off from their peak valuations. So whether it is oil PSU basket, which will see reduction in their subsidy burden and better earnings and working capital cycle profile, or banks, including a mix of private and public sector banks, or some of the engineering and cap goods sector is the one where we will deploy incremental money.
Dhiraj, very quickly, we are already at 6,500. Your year-end target for the Nifty, and what do you foresee happening pre-elections?
We don't give year-end targets, but our expectation is that if there is a market-friendly government in place post-election, you might see rally further gaining momentum and the new highs getting sustained.
What's your gut call? 7,000 how soon?
We don't give, as a house, we don't give Nifty target, but we believe that new highs can be sustained.
And pre-election?
It's possible because in the last time people missed out and the markets opened gap up post-election. So this time you might see the rally getting preponed before election. So it's possible that it can happen before the elections.